Let's actually bring them in. Dan Deming of Stutland Equities. Dan has been trading options and futures for more than 20 years. He's over at the Chicago Board Options Exchange. Back with us right here in the New York studio, Sri-Kumar. He's Chief Global Strategist at the Trust Company of the West, TCW. He helps manage about $110 billion in assets. And Sri, let me kick it off with you. Great to have you back with us.
Thank you. Good to be here.
I'm hearing czars say, okay, there's more bulls than last week, less people calling for a correction. What do you think? Is that a contrarian indicator in your view?
Well, the bulls, or the number of bullish sentiment that you see always goes up, Carol, when you see the stock market going up. But I think you really want to ask why the markets are up so much. Keep in mind that as late as August 27th, when Chairman Bernanke gave his Jackson Hole speech, everybody was looking for a double dip and everybody was quite negative in terms of the sentiment. I think the QE2 created more bullish sentiment than I had anticipated. Then, of course, you had the fiscal settlement that President Obama reached in December, which again helped carry it on. But I would say that the market is still not running up by itself. It is artificially stimulated.
Before, I want to get Dan's take on the close, but before we do that, I want to just get your quick take on Europe, Sri. Jim McColgan on earlier said that he thinks a restructuring is inevitable, so obviously problems down the line for Europe, but not that it should affect U.S. equities that bad because of the recovery that we're looking at here and because of the valuations we're looking at here. You, though, are still bearish.
I think the European debt is a risk for global equities in general and U.S. equities in particular, Matt. And Jim talked earlier about the European situation being a problem in 2012. I don't think we are going to wait that long. If Spain comes in the crosshairs in the next few months, and Italy is already being talked about because of the extent of its debt that it has run up, then these are two countries, the markets are not going to wait until 2012, and they are too big to bail out, and that means the U.S. equity market takes an impact pretty significantly this year alone.